Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss tax deductions, Roth conversions under One Big Beautiful Bill Act. As well, we'll take a look at tax reporting for restricted stock units and venture on over to the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we good, sir?
Doing good. Yeah, kind of right in the heart of tax season. So busy, but I like this time of year. You work really hard for 3.5, 4 months. You get a lot done. You don't have any time to spend any money, so it's good for the personal budget. It's you got to look at the positives, right?
Yes, sir. Always focus on the positives. All right. Well, let's dive right in. Tax deductions. The tax season for 2025. It's been an interesting one. You folks have definitely had to keep your eye on many changes that have occurred. So, where do we want to dive in with this?
Yeah, exactly. There's been a number of changes, and this is a year I think, it's important if people prepare their own taxes, or, even if they're having a professional, maybe ask some questions to make sure that, these changes are being reflected on their return, which, from what we're seeing and from what the national statistics show in general are positive, that the average tax refund is up, a fair amount. I think it was, $1,200 or something like that for the average person. Not everyone, right? Not everyone will qualify for some of these deductions, and some will benefit more than that. So it'll average out. But yeah, it's definitely worth just, taking a moment to review and seeing what impact they may have. And then, of course, thinking for future years, because a lot of these deductions are go from 2025 to 2028. So there's still several more years where maybe someone may be able to rearrange their finances a little bit to be able to take advantage of them.
Yes, sir. Well, let's dive into some of those different things as far as deduction trends that are encouraging, contributing to retirement accounts, buying a home, charitable donations, as well as looking at some of the different deductions that may be available based upon income as well. So, what if we talk about, let's dive in for those that will itemize rather than a standard deduction.
Right. Yeah. So, more and more people are taking the standard deduction, right? Because it's increased so much. For single filer, it's $15,750. For married couples is $31,500. So, pretty big a hurdle that you have to get over to itemize. And that was especially true in previous years. But in this year, there was a change that maybe changes that math a little bit. So prior to 2025, ever since the 2017 Tax Act, there was a cap, a $10,000 cap on the itemized deductions for state and local taxes, right? Often called the SALT deduction. And so a lot of people, if, maybe they had high property taxes, maybe they're in a high income tax state, that would have been a pretty big deduction. But if it's capped at 10,000 and the standard deduction is 31, it may be unlikely they're going to have another $21,500 in deductions to put them over that threshold. But in 2025, that $10,000 cap was raised to 40,000 for most taxpayers. That does start to phase out. So higher income taxpayers will likely still be stuck at that $10,000 cap and maybe less likely to itemize. But for a lot of lower to middle income, 40,000 is a pretty big increase.
Yeah.
And really it's taken us back to tax planning, where we start looking at, when do you pay state taxes due if you have a big event, right? Where, stock options or sell real estate or, you name it. where you're going to have this state tax bill. When you pay that could matter again, right? Because you may be able to pay it in the year that the income was earned and get a deduction, or maybe if that deduction is going to be limited or not full, you're not going to fully benefit from it. You may be better off waiting and paying it with the tax return so that you can take that deduction in the following year. So that's really one of the big areas where we're seeing some impact.
Yeah, well, and other areas of itemized deductions, I mean, mortgage interest, charitable donations, medical costs over a certain amount. So these are things to keep in mind too, that may add up more than the standard deductions. So let's dive into medical expenses. What's kind of the threshold there?
Yeah, you brought up kind of the big three, and really it's the big two. It's mortgage interest and charitable deductions are kind of the big two that you see most often. Really no changes there in terms of the law, so it kind of is what it is. But medical is one where we get a lot of questions, and it's pretty rare that people qualify to get a benefit or much of a benefit. And that's because medical expenses, really all the out-of-pocket money paid for medical insurance or co-pays or all of those things. It has to exceed 7.5% of the taxpayer's income to get a deduction, right? So only the amount that's over 7.5%. So if your total income is 100,000, the first $7,500 does not benefit you. It's only the amount over that. So as I usually say, if you're able to claim the medical expense deduction, you probably had a pretty bad year, right? It's something major. Although the one area where we do see that a lot is when people go into assisted living or a care home or something like that, right? Obviously, then the expenses can be quite significant and often will exceed that threshold. But for the average person, they can often just kind of do some, quick back of the head math and say, okay, what's my rough income? 7.5%. Do I have any chance of adding up all of my, medical expenses and exceeding that number? And if not, then it's probably not worth the effort.
Yeah. Let's talk charitable donations. Oftentimes there is a bit of confusion around what actually is a deductible charitable donation and what really around the threshold of that is.
Yeah, so with charitable, you have cash donations and non-cash, right? Items that you donate. The first thing with cash donations that's often misunderstood is you need to have that letter that says you donated this much and no goods or services were received. People will buy things at a charitable auction and say, oh, I gave this much, I wrote a check for this much to the charity, that's deductible. Well, no, because you received goods or services in return for that donation. And the truth is, many times in charitable auction, because the goods or services are donated and you're actually paying less than what you normally would have to pay for it, right? The only way you would get any deduction is if your donation exceeded the value of those goods and services, then that portion would be deductible. And then there's also, some limits. So cash contributions to charity, you can deduct up to 60% of your income. So, really very high. Again, as an example, if your income's 100,000, you could take up to $60,000 as a tax deduction if you gave that much to charity. But then there's other lower limits. So if you use long-term capital gain property, let's say you have a stock that you've held for years, it's gone up a lot. If you were to sell it, you'd have to pay taxes on that income, right? So instead, you donate that shares of that stock to charity, and then the charity can sell it. And because they're a charity, they don't face income taxes, and they can use it for their purposes. And so you kind of get a double benefit, right? You get the benefit of donating to the charity and taking a deduction, and you get the benefit of not paying the taxes on the gain. But if you do that, then instead of a 60% limit, there's a 30% limit. So if your income's 100,000, you could only, deduct up to 30,000 as a total. So anybody making large gifts wants to be aware of that. For non-cash, if you make a non-cash contribution of $500 or less, it's pretty simple. Documentation isn't needed on the tax return, right? You can just list it. But for larger contributions, you have to actually report, what charity you gave it to, when, kind of how you valued it, what condition it was in, that type of thing. And then something that can come up, it's fairly rare, but if the property is worth more than $5,000, then an appraisal is required. So occasionally, we have had clients donate some very interesting items and things with high value to a charity. But the IRS doesn't want you just, doing a rough calculation of what those higher dollar items may be worth. They want an actual appraiser who has expertise in that area determining that value.
What about above the line deductions?
Yeah, so this is one of those terms, right, that comes from years ago that really doesn't make sense anymore since they've redesigned the tax forms. But it used to be the line was the dividing line between the first page of the 1040 main tax form and the second page, right? And so you had above the line deductions that were the more attractive deductions, and then you had below the line, which were the itemized deductions, right? Itemized or standard deduction. So above the line, we includes things like IRA contributions, student loan interest, if the taxpayer qualifies based on their income, health savings account contributions, things like that. But we also have a number of others that have kicked in. The deduction for tips, the no tax on overtime pay, which we've talked about, and then also the extra deduction for seniors, people over age 65. Again, all of these have income phase outs and some fairly complex rules, but for those that qualify, those are really above the line deductions in addition to their itemized deductions or standard deduction, which are typically the more attractive deductions.
Yeah, here you also outline the situations if both a taxpayer and their spouse are not covered by a retirement plan at work, they can take the full deduction for a traditional IRA contribution at any income level. So, is that new, or is there just an adjustment around this as of this year?
Yeah, no, nothing new there, but it is an area of common misunderstanding. So if neither spouse is covered by a retirement plan, they can make deductible contributions to a retirement plan or to an IRA. If one of them is, then there's an income threshold, right, as to whether they can make a contribution for the other spouse. If their income exceeds that threshold, even though the other spouse is not covered by a plan, they're not able to make a deductible IRA contribution. And then if both of them are covered, there's another income limit that's really quite low. So in most cases, people would not qualify to make a traditional IRA, a deductible traditional IRA contribution. So a lot of times people think, okay, that they can kind of double dip or, max out their 401k and do the IRA. And we have to say, no, your income exceeded. So you actually have to get that money plus the earnings back out of the IRA, which can be kind of cumbersome. So it is important that people kind of have an understanding of if they're covered by a retirement plan at work, that usually is the primary vehicle. And, some of these other above the line options may not be available to them because they're getting it through a 401k, let's say.
Yeah. Let's dive in a little bit more around employees as far as the overtime. There's been a little ambiguity there. We've touched on it prior, but I think it's important to dig into a few facets of it, which include employers not being they're not required to report qualified overtime on employees' W-2s. So this is something for the individual to keep in mind. They may have to do the tracking on that.
Yeah, for 2025, the employers are not required to report it, which has created kind of a mess. Although I have to say, at least with what I've seen, about 90% of employers have been reporting it in box 14. They've been doing the calculations, which has been nice. In the few cases where they haven't, it's become really difficult because, overtime is paid based on state law, and federal law in many cases differs as to what qualifies. So, in some cases we've gone back to the pay stubs, but the challenge is federal overtime law is weekly. based on the number of hours per week. Whereas a lot of times someone's paycheck is biweekly, right? It covers 2 weeks or it covers, half of a month. And so you don't know exactly what days they worked. And if you start throwing in things like vacation or holiday pay, that doesn't count towards the 40-hour work week. So they may have worked overtime based on state law, but because there was a holiday in there, they actually didn't work over 40 hours. So it wouldn't qualify under federal law. So it has become really tricky in the cases where the employer hasn't reported it. But in cases where the employer does, it's been very convenient. And what I found is some of those deductions add up for some professions where overtime is the norm.
Yeah, absolutely. As far as those deductions can go concerning overtime, what are the limits around that?
Well, a taxpayer can deduct up to $12,500 if they file individually, or $25,000 if they file a joint return. But it starts to phase out. So once you hit $150,000 for individual filers, $300,000 for joint filers, at that point you begin to lose the full amount of the deduction. So yeah, even though there may be some overtime there, depending on the taxpayer's income, also depends on their profession. Not every profession that receives tips is eligible. So there's a number of things to dive into to determine what the actual tax deduction may be.
Yes, sir. Last but certainly not least, for seniors age 65 and older, there is an additional deduction. What is that? What do we want them to understand?
Yeah, this is probably where we've seen the biggest benefit. So for anyone over age 65, they get an additional deduction of up to $6,000. So for a married couple, that could be $12,000. So a pretty good chunk, enough of a deduction to move the needle. But it does phase out. So single filers, when their income exceeds 75,000, they start to lose the deduction as their income goes up. For married filing joint, it's 150,000. But even with that, I've seen a lot of tax returns where people have exceeded that income threshold, but the benefit wasn't fully phased out, right? They just received a portion of the payment, maybe not the full 6,000 or 12,000, but still enough that it had a meaningful impact on their tax refund.
Yes, sir. Just to keep in mind, as you pointed out with some of this, in many cases, state laws will not conform to the changes. So that's important to keep in mind, depending on what state you're filing in.
Yeah, because there may be some adjustments or things that you have to take into account. And of course, we've only talked about a fairly small number of deductions here. I mean, there's a lot of different tax deductions, but a lot of those deductions may only impact a very small percentage of people. So we don't want to, do a full listing of all the different potential deductions, but more just the ones that the general public should be available or should be knowledgeable about, because it's a higher likelihood that they may benefit from them.
Yes, sir. All right, let's jump to Roth conversions under the One Big Beautiful Bill Act. With the new temporary below-the-line deductions enacted by the One Big Beautiful Bill Act, taxpayers may now have more planning considerations for Roth conversions. What are some of those considerations?
Yeah, so this kind of dovetails with what we were just talking about. Let's say you have a married couple and their income's low enough that they're going to get this added $12,000 deduction. And maybe that would even put them into a lower tax bracket. And they're saying, well, I want to use up some of that lower tax bracket. They could do things like a Roth conversion, where basically they convert money from a traditional IRA into a Roth IRA and pay the taxes at that time when they do that conversion. And if they're in a low tax bracket, that may be helpful, right? Use up that low tax rate and then have the money growing tax free in a Roth until it's needed sometime down the road. So yeah, these additional deductions have created some additional wiggle room, with some of the kind of traditional tax planning strategies.
What are we seeing as far as the impact for seniors age 65 and plus?
Yeah. So, a lot of times there's kind of this sweet spot where, someone retires, let's say they retire at 65. They don't have to take required distributions from their retirement accounts until age 73. So they've got an 8-year gap there, where there's no mandatory distributions that they have to pay income on, and they have a lot of flexibility. And now, if you add in, till 2028, this added deduction, that usually, or that often is kind of a sweet spot where they may be able to do Roth conversions, get some of that taxable retirement money into a tax-free vehicle by paying the taxes when they're in that gap, where their income may be low enough that they can pay the tax at a lower tax rate. So that's it's an opportunity that people should be aware of and should be doing that planning.
Yeah. When is it ideal for a Roth conversion, for someone to really look into it and exercise the option?
Well, I mean that comes down to a lot of specific factors, right, around the individual, because everyone's retirement plan is different. Their income sources, deductions, and things are different. And their attitudes about, prepaying taxes or deferring taxes as long as possible, what the end goals are with that money, will it go to heirs eventually? What will their tax rate be? So there's a lot of different factors, and it usually is a pretty extensive conversation of the pros and cons, and the cost benefit, and if it makes sense. But generally, that sweet spot between age 65 and 73, for someone who can keep their tax rate fairly low so that they could do Roth conversions at a lower tax rate, and has a large amount of taxable retirement money, but not a lot of after-tax money.
Okay. Yeah. You also state that it may be more beneficial to pay the conversion taxes with outside funds rather than from the conversion itself. Why is that?
Well, if it's possible, you want to get as much money into a Roth IRA as you can, because at that point, that money is tax-free and the growth is tax-free. So if you move money from an IRA and you have the taxes withheld, so let's just say, as an example, you're doing a $10,000 Roth conversion and the taxes are $2,000. If you use the $2,000 from the conversion to pay the taxes, you only end up with $8,000 in the Roth, right? So if you have money outside money that you can use to pay the taxes, you can get the full amount of $10,000 into the Roth. And then you're taking after-tax money that otherwise would be taxable. Its earnings would be taxable in the year earned, whether that's interest, dividends, et cetera, and sending that to the IRS and keeping more money in the Roth that can grow tax-free.
All right. Anything else you want to add to Roth conversions under the One Big Beautiful Bill Act?
Well, again, just it's complex, definitely advisable to seek professional advice, really run the numbers and understand those pros and cons before committing to something, because, you don't want to accidentally engage in some activities or strategies that leads to a higher than expected tax bill.
Yes, sir. All right, let's dive into tax reporting for restricted stock units. Restricted stock units, RSUs, are stock that are granted to an employee as part of their overall compensation package. So let's dive in there a little bit. And what's kind of the difference between RSUs and incentive stock options?
Yeah, so RSUs is basically stock that's granted to an employee. Employee doesn't need to pay anything for them. It's part of their compensation, right? So and they are granted these shares. It's not theirs right away. They have to continue working for a certain time period, and then those shares vest. And at that point, it becomes the employee's property. They now own those shares of stock. And when it vests, that's a taxable event, right? So just under the tax code, it doesn't matter whether a company pays you in cash and stock and anything else. It's the value of that is taxable as compensation. So with those restricted stock, they vest, you pay the taxes, you now hold the stock. Incentive stock options, can be a lot more complicated. The employee does pay something for the stock, but generally the idea is they get the appreciation of the stock, not the outright grant of the stock. And what both these have in common is the tax reporting can be fairly complex, and that's what we want to make people aware of. Incentive stock options are less and less common now. They used to be very common 25 years ago. Restricted stock units are by far the norm. But the way they work for most people is when that stock vests, there's required tax withholding on that compensation. And so typically the employer or their agent will sell a certain number of shares in order to cover the tax withholding, right? And then the employee will keep the remainder. So what that does is it creates reporting on their Form W-2 of this compensation, right? And the tax withholding. But then also it generates a Form 1099-B that reports the sale of the stock, usually by the custodian that holds those shares. And so a lot of times people get the W-2, but not realize there's a 1099-B out there, and it needs to be reported. Otherwise, as far as the IRS knows, the full amount of the stock was taxable. The full amount of the stock value, what was sold, was taxable. You need to be able to go in and figure out what that tax basis was, what amount they've already paid taxes on when it vested, to determine the amount of gain or loss. So just something for people to be aware of if you have restricted stock and you have any vesting that happens during the year. You not only need your W-2 to file your taxes, but you also need to log on to the website of the stock agent that does all of the reporting and monitoring and holding of the shares to see what tax forms they have issued as well.
All right. Let's jump on over to the Plan Solutions Incorporated office bulletin board. We've got 2 items pinned up there, Mr. Armour. Which one do you want to start with?
So the first one we've talked about, non-retirement Form 1099. So this would be for like individual joint trust accounts, things like that. They're often delayed, or if they're issued on time, they're often subject to corrections, right? So typically telling people, you have to be a little bit patient. Let's wait and see if there's any corrections that occur. But for our clients, Schwab is one of our larger custodians. According to Schwab, the final batch of 1099s were due to be posted at the end of February. It looks like that has happened. Pretty much everything is posted. A few of them that were posted earlier were corrected. But I think at this point, it's pretty low risk that there'll be any major changes to those 1099s. So I think clients with a fairly high degree of confidence can go ahead and file their tax returns with that latest 1099 that's been posted.
All right. And what's the second item that we have pinned up there?
Well, the second one, and this might be something we talk about in future podcasts, future newsletters, but, just letting clients know, obviously with the military activity in Iran, we've definitely seen some impact in the markets. So far the stock market's kind of dipped and recovered, but maybe down a little bit. We've seen some really big moves in the currency markets, which, impacts foreign investments. And of course, the commodity markets, especially oil, has been a big area of focus. So at this point, I think it's still too early to know the overall impact, how long this may last, what, if any, longer term implications it may have on the market. But it is something that we're watching closely. As we've talked about in past podcasts, in terms of our investment philosophy, we do have tools in place specifically designed to manage this type of risk or this type of uncertainty. And so, we'll monitor the developments closely and really, lean on those tools to tell us what, if anything, we need to do to manage these potential risks.
Yes, sir. Yes, sir. Anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
I would just say, anyone who's kind of, sitting and waiting and gathering forms to get started on their taxes, this is probably a good time to get going. Any tax preparer, or even the tax agencies, tend to get overwhelmed as we get closer to April 15th. And so most people have a better experience, and I think get better service if they if they try and at least get the process started, a month or so before the deadline. So there's plenty of time to chase down any additional information, do the longer term tax planning, search through and see if there's any additional deductions or credits or things like that.
Yes, sir. Well, thank you for listening to the Plan Solutions Incorporated podcast. Please hit that subscribe button on whatever platform you're listening on if it's your first time, and leave a rating and review, and please share with someone else that you think will get value out of the podcast, as we don't do any external advertising. And if you want to subscribe to the written form of the content we discuss here, the personal financial review, it's simple to subscribe. Just send Katie an email, katie@plansolutions.com, and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.